Welcome to the Opening Bell Report.
Today, we are unpacking what I can only describe as a phenomenal convergence of distressed finance and military procurement.
It really is.
And if you're listening today, we're glad you're joining us because the focal point of this deep dive is an extensive analysis report that breaks down a massive structural anomaly.
A true anomaly.
Exactly. One that hit the tape on Tuesday, March 3, 2026.
Right.
We're looking at how a U.S. Navy contract essentially reached down and pulled a microcap technology company.
Barely hanging on.
Barely hanging on, yeah. A company named Mobix Labs, ticker symbol MOBX, and pulled them right out of a terminal tailspin.
It was a violent shift.
The sheer market mechanics of what happened that Tuesday, they're staggering.
Yeah, absolutely staggering.
Just to give you the headline numbers right off the bat, we were talking about a stock trading at a previous close of 18 cents.
18 cents?
Right, and it just exploded to an intraday high of $1.24.
Which is just wild to watch in real time.
Yeah. Oh, completely. It ultimately closed up over 530%.
Yeah.
For anyone watching the ticker that day, the velocity of that repricing was basically a masterclass in market psychology and momentum ignition.
The velocity is really what immediately stands out. I mean, when a microcap equity experiences a 530% single-day rally.
People usually assume it's a meme stock.
Exactly. The initial assumption is often that we're looking at a coordinated retail squeeze or just an ephemeral pump and dump.
Right.
But the data in the analysis report paints a very different picture here.
It wasn't retail hype.
No. This was a violent, fundamental repricing of a company's entire risk profile.
Yeah.
In a single trading session, Mobix Labs transitioned from being a severely distressed asset priced for imminent bankruptcy to a validated production-level defense contractor.
That is a massive pivot.
Huge. The catalyst wasn't some internet rumor. It was a tangible, structural lifeline in the form of a purchase order for the U.S. Navy's Tomahawk cruise missile program.
And that structural lifeline is exactly where we need to start unpacking this. Yeah, let's get into it.
Because the morning press release confirming this production purchase order, that was the match that lit the powder keg.
It was.
But looking closely at the specifics of what Mobix Labs is actually manufacturing for the Navy, it changes the context.
Completely changed.
It goes from a simple vendor agreement to what looks like a strategic moat. So according to the analysis report, they are supplying high reliability filtering components.
Right.
Can you break down for everyone what that actually means in this context?
Sure. So in the current geopolitical landscape, the primary threat to a Tomahawk cruise missile isn't just kinetic interception anymore.
Like getting shot down.
Right, like another missile hitting it. The real threat today is the electronic warfare environment.
Okay.
You're talking about highly saturated airspace where signal jamming, GPS spoofing, and electromagnetic interference are deployed to essentially blind incoming ordnance.
So they try to scramble the missile's brain. Exactly. And these filtering components that Mobix Labs makes, they are the defensive shield for the missile's internal guidance and communication avionics.
Which means this component is not just some supplementary feature?
No, not at all.
Yeah.
It is mission critical.
Right.
And to fully grasp the barrier to entry here, you really have to look at the military specification testing.
The mil-spec stuff.
Right, mil-spec. The testing required for these environments is brutal. A component integrated into a Tomahawk doesn't just sit in a climate-controlled server rack.
Obviously.
It has to survive extreme thermal fluctuations, intense vibrational G-forces during launch and flight, and highly concentrated electromagnetic radiation.
All without failing.
Without even a microsecond of signal degradation. Because a microsecond of failure means the missile misses its target.
Wow.
Yeah. Getting a piece of proprietary technology to pass those specific thresholds takes years of capital-intensive research and development.
Which have to be incredibly grueling for a small tech firm.
It's notoriously grueling. Most don't survive it.
And that actually brings us to a crucial distinction highlighted in the analysis report.
Yes.
CEO Phil Sansone made a statement that fundamentally shifted the institutional outlook on the stock.
The production comment.
Exactly. He made it explicitly clear that Mobix Labs is not operating in an R&D test phase with this contract.
Right.
They aren't just handing over a prototype and, crossing their fingers hoping the Department of Defense decides to fund further testing.
They are an approved production-ready supplier.
Production ready. They are integrated directly into the active supply chain of one of the most prolific and continuously upgraded long-range strike weapons in the U.S. arsenal.
And we really need to pause on that because crossing the chasm from an R&D pilot program to a production-ready supplier is the most significant bottleneck in defense procurement.
I've heard it called the Valley of Death.
Yes, the Valley of Death for defense startups. The DoD is famous for funding endless R&D projects that just never see the battlefield.
Who just bleed cash until they die.
Exactly. But by securing an active production order, Mobix Labs has crossed that valley.
They made it to the other side.
They did. The validation aspect here cannot be overstated. Once you are designed into a core platform like the Tomahawk, you are essentially bolted onto a continuous revenue stream.
Because the Navy is constantly using them.
Right. The Navy actively deploys these missiles on surface ships and attacks submarines globally.
And they upgrade them, right?
Constantly. As the military transitions to newer iterations, like the Block V Tomahawk with enhanced anti-ship capabilities, they constantly replenish and upgrade their stockpiles.
Makes sense.
So being a permanent fixture in that architecture guarantees that as DoD procurement scales, the demand for this specific filtering component scales right along with it.
So that validation is the catalyst.
Yes.
But to understand the absolute ferocity of the market's reaction that Tuesday, we have to look at the severe distress Wall Street was pricing into Mobix Labs on Monday.
The day before the explosion.
The day prior, yeah. Because a 530% gain doesn't happen in a vacuum. It happens because the baseline was so historically depressed. According to the analysis report, on Monday, the stock was just languishing at 17 cents.
17 cents a share.
Over the previous 12 months, the equity had suffered a brutal, grinding drawdown of more than 85%.
Just painful for anyone holding it.
We were looking at a total market capitalization of roughly $18 million.
Which is nothing in the public markets.
Right. An $18 million valuation for a hardware technology company is functionally a distressed asset tag.
It is the textbook definition of a distressed valuation.
Yeah.
At an $18 million market cap, Wall Street is no longer evaluating your technology.
What are they evaluating?
They're simply running a countdown clock on your balance sheet.
Waiting for the money to run out.
Exactly. The market was actively pricing in a terminal liquidity event.
Bankruptcy.
Or close to it. When a microcap company burns cash without a clear path to scalable revenue, institutional investors and short sellers, they literally calculate the exact month the company will run out of runway.
And what was the assumption here?
The assumption was that Mobix Labs would be forced into toxic, highly dilutive financing.
Ah, right.
Things like floralist convertible notes or massive warrant-heavy equity offerings, just to keep the lights on.
And that kind of financing essentially wipes out existing equity holders.
It completely crushes them. So that 17-cent share price wasn't a reflection of the company's intrinsic technological value.
Right.
It was a pure reflection of extreme financing risk.
And then Tuesday morning hits.
Boom.
Boom. The narrative pivots violently from venture-level financing risk to government-backed production revenue.
Overnight.
Yeah, overnight. The psychology of the trading tape that morning is just a prime example of a short squeeze colliding with algorithmic momentum ignition.
It was a perfect storm.
It really was. When that press release hit the wires, every short seller who was comfortably waiting for the company to file for bankruptcy
Suddenly woke up in a nightmare.
suddenly found themselves trapped in a structurally validated defense play. And the rush to cover those short positions provided the initial upward thrust.
Which then triggers the machines.
Exactly. It immediately triggered high-frequency trading algorithms scanning for unusual pre-market volume and volatility.
And that algorithmic participation is what turns a strong catalyst into a historic anomaly.
Break that down a bit.
Well, you have natural buyers realizing the bankruptcy thesis is dead.
Okay.
You have short sellers scrambling to buy back shares to close their positions at a massive loss.
Adding fuel to the fire.
Right? And then you have momentum algorithms instantly layering in massive bid support to ride the wave.
It's just buyers stacked on buyers.
Yes. Wall Street operates as a forward-looking discounting mechanism. Within hours, the market had to completely discard the distressed financing model.
Throw it out the window.
Throw it out and build a completely new valuation model based on recurring DoD revenue and a secured operational runway.
And that violent recalibration is what launched the stock past the $1 mark.
Yeah.
Let's actually look at the sheer market microstructure of that recalibration. Because the volume metrics from March 3rd in the analysis report are almost difficult to process.
They're astronomical.
We are talking about 1.36 billion shares traded in a single session.
Billion. With a B.
Billion. To give that number some context for you listening, the average daily volume for MOBX prior to this catalyst was around 2.88 million shares.
So it went from 2.8 million to 1.3 billion.
The daily volume expanded by a multiple of roughly 4,070,000,000.
When you see 1.36 billion shares traded on a microcap company, you really have to look closely at the float.
The available shares?
Right, the actual number of shares available for public trading. Mobix Labs does not have a billion shares outstanding.
Not even close.
Not even close. So that volume figure indicates an extreme float rotation.
Meaning the same shares are being bought and sold over and over.
Exactly. The entire available supply of stock changed hands dozens, perhaps hundreds of times between the opening bell and the market close.
How does it even happen physically?
It happens when high-frequency market makers and proprietary trading desks step in to provide liquidity. You have this overwhelming flood of retail and institutional orders.
Right.
And these algorithms are buying and selling the same exact shares in fractions of a second,
Just slipping them.
capturing microspreads. And that artificially inflates the aggregate volume numbers on the tape.
It also creates an incredibly dangerous environment for retail traders trying to manually navigate that tape.
Oh, incredibly dangerous.
The intraday volatility was immense. As the analysis report notes, we saw the price action swing from an early morning level of 38 cents, rip all the way up to $1.24, and experience multiple double-digit percentage pullbacks along the way.
Just massive whiplash.
That expansion in market cap, growing from sub-20 million to over $113 million in a matter of hours, it creates massive dislocation.
It does.
For day traders, that intraday range is highly lucrative, but it also signals that the asset is completely decoupled from traditional fundamental valuation metrics for the duration of that session.
Decoupled is the perfect word for it.
Yeah.
In the midst of a multi-billion share float rotation, the stock price is purely a function of supply, demand, and order flow momentum.
And nobody's doing math at that point.
No one buying at $1.20 that afternoon was doing a discounted cash flow analysis on the margins of Tomahawk filtering components.
They were just trading the tape.
Exactly. But the fundamental reality of the business eventually has to reassert itself.
And here comes the reality check.
Here it comes. Securing a U.S. Navy purchase order is a monumental commercial victory.
Undeniably.
However, fulfilling a U.S. Navy purchase order is a massive capital expenditure.
It costs money to make the parts.
Exactly. This is where the initial euphoria has to be weighed against the sobering realities of defense contracting.
And this is where we need to introduce some friction to the narrative. Because the Department of Defense is not known for its rapid payment schedules.
No, they're not.
Defense contracts frequently operate on net 90 or even net 120 payment terms.
Meaning you don't see a dime for months.
Right. They pay upon delivery and inspection, or based on strict milestone completions.
But the costs are upfront.
Exactly. Mobix Labs has to procure raw materials, secure specialized labor, and scale their manufacturing infrastructure to meet stringent mil-spec quality controls right now.
Today.
They need upfront capital to fund the production cycle long before the Treasury cuts them a check.
Right.
And looking at their balance sheet prior to this rally, according to the analysis report, they are entirely unequipped for that capital outlay.
Completely unequipped.
With a current ratio sitting at a razor-thin 0.11, they have virtually zero liquidity to fulfill this order.
Yeah.
So a capital raise isn't just likely, it's a mathematical necessity.
It really is. That current ratio of 0.11 is the most critical fundamental metric in this entire scenario.
Explain why that number is so terrifying.
Well, for every dollar of immediate liability they only have 11 cents of liquid assets.
Wow.
They are operating on fumes. So you have a company that just won a golden ticket, but they literally lack the bus fare to get to the factory.
That's a great way to put it.
And the market is fully aware of this working capital gap. Management is highly incentivized. In fact, they have a fiduciary duty to use this explosive 530% rally to repair their balance sheet.
They have to strike while the iron is hot.
They have to. The most logical corporate action is to execute an at-the-market equity offering, or an ATM, immediately.
Meaning selling new shares.
Yes. They will issue millions of new shares into this massive liquidity pool created by the 1.3 billion share trading volume.
To extract the cash.
To extract the cash required to actually build the components.
Which introduces the ultimate irony of these microcap explosion events.
Yeah.
The very catalyst that saves the company from bankruptcy requires a mechanism that inherently dilutes the shareholders who just aggressively bought into the rally.
It's a tough pill to swallow.
By issuing new shares at these elevated prices, management secures the cash to fulfill the Navy contract.
Which they need to survive.
Which ensures their long-term survival right.
Yeah.
But that sudden influx of new share supply into the market inherently pressures the stock price back down.
It is the defining paradox of distressed growth.
Yeah.
The stock pump is the funding mechanism.
Without it, they're dead.
Without the 530% rally, Mobix Labs would have had to secure debt at predatory interest rates or sell equity at a massive discount.
Assuming they could even find buyers at all.
Exactly. So the retail and algorithmic momentum effectively served as an impromptu, highly lucrative funding round for the company.
A crowdsourced bailout, almost.
Kinda, yeah. However, for the secondary market participants, the traders and investors navigating the aftermath, this creates an incredibly volatile landscape.
Because it's not over.
Far from it. A stock doesn't trade 1.3 billion shares and simply stabilize the next morning.
No, the tape is going to be incredibly messy going forward. We are looking at a sustained, high-volume tug-of-war.
A massive battle.
On the bid side, you have retail momentum traders who are anchored to the DoD validation.
They're waiting for the next PR update.
Right, they're expecting updates, looking for another breakout above that $20 level.
And on the ask side?
On the ask side, you have sophisticated institutional short sellers aggressively repositioning.
The smart money.
Right. They are looking at the 0.11 current ratio. They are modeling the exact size of the impending dilutive capital raise.
They know it's coming.
They know it. And they are actively shorting into every spike, betting that the weight of the new share issuance will inevitably drag the price back down toward its historical moving averages.
And because of that dynamic, the technical trading range will likely remain highly erratic.
Churning violently.
Yeah, churning violently between the 80-cent and $1.30 marks as this battle of attrition plays out.
Who wins that battle?
Well, the institutional shorts have the fundamental math of dilution on their side.
True.
But shorting a microcap with a newly established U.S. Navy contract is remarkably dangerous.
Because another catalyst could hit.
Exactly. If Mobix Labs announces subsequent purchase orders, or if another defense prime contractor decides this filtering technology is worth acquiring the entire $113 million company for.
Oh, an acquisition.
Right. If that happens, those short sellers could face another devastating squeeze.
So the risk hasn't disappeared?
Not at all. The risk profile has just shifted from the threat of corporate bankruptcy to extreme equity volatility.
It is just a textbook study of how market microstructure reacts to severe fundamental shocks.
A case study for the ages.
It really is. So let's pull all these threads together and evaluate the broader mechanics we've explored today based on the analysis report.
Sounds good.
The trajectory of Mobix Labs on March 3rd is a phenomenal, real-world example of how a single procurement decision can upend a market.
Completely upend it.
We watched a microcap tech firm burdened by an 85% drawdown and functionally priced for extinction, suddenly integrated into the supply chain of the U.S. Navy's Tomahawk missile program.
And the market realized it instantly.
Right. The ensuing 530% repricing wasn't just retail hype, it was a violent algorithmic and institutional realization that the company's revenue model had shifted from speculative venture to sovereign-backed defense procurement.
A totally new reality.
But as we've outlined, surviving the distressed financing death spiral is only the first phase.
Yes. The operational pivot is where the real work begins.
The hard part.
Exactly. The initial repricing is complete. The market has recalibrated MOBX from a distressed asset to an active defense supplier.
Okay.
But the focus now shifts entirely to execution.
Right.
Can management successfully thread the needle of executing a dilutive capital raise without entirely collapsing the share price?
It's a tightrope walk.
It is. Can they scale highly specialized mil-spec manufacturing with newly acquired capital while maintaining strict DoD delivery timelines?
Because the Navy doesn't tolerate delays.
No, they do not. The U.S. Navy contract provided the life raft, but the company still has to navigate the incredibly complex waters of defense sector working capital.
The narrative has fundamentally shifted, and the coming quarters will prove whether they can transition from a phenomenal trading anomaly into a sustainable defense contractor.
Time will tell.
Absolutely. Now, before we wrap up, I want to leave you, our listener, with a final thought to consider as you watch this play out.
Something to mull over.
Yeah. When a microcap company experiences a 1.36 billion share float rotation and an instantaneous 530% valuation explosion on the back of a single DoD contract, the market is aggressively pricing in the perfect execution of that contract.
Perfect execution.
But knowing the severe capital constraints and the inevitable dilution required to fund that production, how long can the sheer gravity of market momentum outpace the sobering mathematics of corporate balance sheets? Are we witnessing the permanent stabilization of Mobix Labs, or simply the opening bell of a much more complex financial restructuring?
Great question.
Something to keep an eye on. Thank you for joining us for this deep dive into the analysis report. We will be back next time to break down the next major shift in the markets.
Don't forget to like, share, and subscribe for more.